Hello and welcome. Today we will discuss about the legal frameworks and investor protections again, and then contractual nature of the bonds. So let's start with this. So when you buy a stock, you become a partial owner of the company. But when you buy a bond, you are essentially lending the money. It is the contractual agreement. The issuer promises to pay you interest and return your principal on a specific date. Because you are not an owner, you do not vote on the company issues. Instead, your safety relies entirely on the strength of this legal contract. If the issuer fails to make the payment, they default on the contract. Therefore, understanding the legal framework is not just a paperwork; it is the primary way to we assess if we will actually get our money back or not. So I'll not go with this diagram, which again we discussed. Now, where are these promises written? They are in a document called bond indenture, sometimes called a trustee. Think of this as a rule book for the bond. Okay, so now I'll move again. It is impractical for the thousands of individual bondholders to watch over a company. This is where the trustee comes in. The trustee is usually the bank or trust company. Although the issuer hires them, the trustee acts as a fiduciary, acts in a fiduciary capacity for you, the investors. And we discussed about affirmative covenants and the negative covenants. I'll not go in detail, correct? Okay, let's go through this because it's a talk about different concepts, correct? So when we mentioned earlier covenants earlier, there are two types. The first are affirmative covenants. These are the things that issuer promises to do. They are often administrative and do not restrict the business so much. For example, the issuer promises to the use of bond proceeds as is stated. They promise to maintain their factories and equipment so they can keep generating the revenue. They promise, basically they will pay the interest, they will pay the taxes, they will maintain the insurance and follow the laws. Okay, so let me change the color here. Now let's negative covenants in short again. These are the things issuer promise not to do. These are the crucial because management usually looks out for the shareholders, not you. Negative covenant stops them from doing things that hurts bondholders. For instance, they might limit how much new debt the company can take on, so your claim does not get diluted. They might restrict dividend payments so cash is not drained out to the shareholders, leaving nothing for you. They prevent the company from selling off valuable assets that support your loan. This can be costly for the issuer because they limit business flexibility. And seniority and recovery. It is a vital to know exactly who owes you the money. A parent company or sorry, not seniority. I'm talking about legal identity and SPVs, special purpose vehicle. A parent company or holding company might issue a bond, but the actual assets and cash might sit in a subsidiary. If the parent defaults, you may not have a claim on those assets unless specified. In the world of asset-backed securities (ABS), we use a special purpose vehicle SPV. This is a separate legal entity created just to hold the assets like mortgages. Crucially, the SPV is bankruptcy remote. This means if the bank that originated the loan goes bankrupt, the asset in the SPV are safe and continue paying you. What have we learned? So we learned that the specific legal identity of the issuer determines your claim on the assets. Now seniority and recovery. So if a company fails, not all investors are treated equally. This is defined by a seniority. At the top is a secured debt. These holders have a direct claim on a specific assets like factory or real estate. Next is a senior senior unsecured debt, often called a debenture. They have a general claim on whatever is left. And at the bottom is a subordinated debt. They only get paid if there's the money left after the senior creditors are satisfied. This hierarchy is known as the absolute priority rules. In bankruptcy, you want to be as high up this list as possible to maximize your recovery. And finally, to summarize, it's a very short session, but geography matters. Bond issued in a specific country and currency, like a US company issuing dollars in the US, are domestic bonds. They follow the strict local regulations like Security Exchange Commission registration, SEC. However, there is a market called the Eurobond market. These are the bond issued internationally outside the jurisdiction of the single country. They typically have fewer regulatory constraints and disclosure requirements. This makes them flexible for issuers but potentially riskier for investors who rely on a strict regulatory oversight. So what have we learned? We learned that the where a bond is issued determine the regulatory laws and protect you. So thanks for watching. I'm stopping now. It's very short session, but this helps for us to understand the concept a bit deeper. Thank you.